In December 1989, 1 square meter of land in Tokyo's Ginza district was valued at roughly 30 million yen, more than the price of an average Japanese home. Then, almost without warning, the most celebrated economic machine on earth began to break. Japan had spent the post-war era turning scarcity into abundance. By the 1980s, its factories produced cameras, cars, televisions, machine tools, and semiconductors for the world. Its companies were admired for quality control. Its workers were praised for discipline. Its government, banks, and industrial groups appeared to move as one coordinated system. Foreign commentators wondered whether Japan might eventually overtake the United States as the world's largest economy. But the miracle contained a dangerous assumption that prices could keep rising because everyone believed they would. Land was not merely property. It was collateral, status, retirement security, and proof that Japan's prosperity had no ceiling. Banks lent against inflated property values, companies borrowed to buy more land, and investors treated the stock market as a national scoreboard. At the center of the story was money that had become unusually cheap. After the 1985 Plaza Accord, the value of the Japanese yen rose sharply against the dollar. Japanese exports became more expensive overseas, and policymakers worried that the stronger yen would damage manufacturers. Interest rates were lowered. Credit expanded. The medicine worked, but the dose was enormous. Between 1985 and 1989, Tokyo's Nikkei stock index climbed to nearly 4 times its level. Land prices surged. Corporate executives could borrow against property, purchase more assets, and appear richer without producing a single additional machine or service. The economy was still real. The factories were real. The engineering was world-class. But a second economy had formed on paper, built from expectations. Then the Bank of Japan changed direction to cool speculation. It raised interest rates beginning in 1989. The response was immediate. Stocks fell. Property transactions slowed. Banks discovered that their supposedly safe loans were backed by land that no longer justified the price. On the final trading day of 1989, the Nikkei reached its peak, got off. By the summer of 1990, the decline was unmistakable. This was not a single-day disaster. It was more like a floor, gradually disappearing beneath an entire system. Developers stopped building. Companies delayed investment. Banks rolled over loans rather than admit losses. The official language was careful, but the numbers were not. The Nikkei would lose most of its value over the following years, while land prices in major cities fell for more than a decade. Then, omnisi. The first lesson is familiar now. Financial crises often begin long before ordinary people can see them. During the boom, rising asset prices looked like evidence of strength. After the crash, the same prices were revealed as fragile promises. Japan's problem was not that it had no productive economy. It was that its financial system had mistaken collateral for prosperity. The second lesson was slower and more consequential. When banks carry bad loans, they become cautious. They lend less. Businesses invest less, and weak companies survive because lenders fear recognizing the full loss. Economists later popularized the phrase zombie companies for firms that remained alive through repeated refinancing but contributed little growth. Japan's government tried to compensate. Public works spending increased. Roads, bridges, tunnels, flood control projects, and regional infrastructure expanded. Some projects were useful. Others became symbols of political distribution rather than economic transformation. The state could keep people employed and prevent a sharper collapse, but it could not easily recreate the optimism that had powered the bubble. The Bank of Japan eventually pushed interest rates toward zero. In 1999, it became one of the first central banks to adopt a zero interest rate policy. Later came quantitative easing, an idea that would become familiar across the world after 2008. Japan was experimenting with the tools of a future in which conventional rate cuts were no longer enough. Yet cheap money did not automatically create demand. Prices were no longer rising as people expected. Consumers postponed purchases because tomorrow might be cheaper. Companies accumulated cash rather than expand. Deflation sounds gentle. Falling prices can seem helpful. But when wages and investment weaken alongside them, the result is economic hesitation. Everyone waits for someone else to move first. This is where the story starts to resemble the present. Japan's collapse was not only about stock prices. It was about the transition from a society built around expansion to one built around maintenance. The old promise had been simple. Work hard, join a stable company, buy a home, raise children, and watch each decade become more prosperous than the last. After 1990, that sequence became harder to guarantee. The famous lifetime employment system did not vanish overnight, and it never covered every worker. But large companies became more reluctant to hire young graduates permanently. Temporary and part-time employment expanded. A generation entered adulthood during stagnation, just as the older generation had entered adulthood during miraculous growth. Their economic memories were fundamentally different. Housing told a particularly revealing story. In the boom, owning a home in a major city could seem impossibly expensive because land was treated as a one-way bet. After the bubble, prices became more manageable in many areas, but falling values also changed the meaning of ownership. A house was no longer guaranteed to be a rising asset. It could be shelter, but it might not be wealth. The change in cities was visible at street level. Empty lots appeared where developers had expected towers. Department stores struggled. Traditional shopping streets lost customers to larger suburban complexes and the expanding convenience store network. These small stores became miniature infrastructure. Food, drinks, cash machines, delivery services, and daily necessities available almost around the clock. Convenience was not merely a consumer preference. It was an adaptation to a society where households had less time, more uncertainty, and increasingly varied work schedules. Japan's service economy became exceptionally good at supplying small quantities, short waits, clean public spaces, and reliable routine. In a low-growth world, efficiency could matter more than grand expansion. None. In Senegal, Avarati, Alperne, the demographic problem had been forming before the crash, but stagnation made it harder to solve. Japan's birth rate had already fallen dramatically from post-war highs. The population aged, the workforce began to shrink, and rural communities lost younger residents. An aging society spends differently, saves differently, and asks different questions of government. It cannot simply repeat the growth strategy of a younger country with abundant new workers. In 1990, demographic decline sounded like a distant statistic. In later decades, it became a practical issue. Who would staff hospitals, maintain roads, care for parents, and pay for pensions? Japan was among the first wealthy countries to confront these questions at national scale. But today, many other advanced economies are moving toward the same problem, though at different speeds. This does not mean Japan invented every challenge now facing the world. The comparison has limits. Japan had high household savings, a distinctive banking structure, strong social cohesion, and a relatively closed labor market. Its crisis followed a specific exchange rate agreement, a specific credit boom, and a specific policy response. History does not repeat like a machine. It rhymes through institutions. There were also important things Japan did well. On itself, despite prolonged stagnation, it remained wealthy, safe, technologically capable, and socially organized. Life expectancy stayed high. Public transportation remained reliable. Infrastructure was maintained. The country did not collapse into the dramatic ruin predicted by some commentators. The phrase, "Los decades," captures weak growth, but it can hide the difference between stagnation and catastrophe. That distinction matters because Japan's experience is often used as a warning without specifying what the warning is. Is it a warning against property bubbles? Against delaying bank reform? Against relying on public spending? Against deflation? Against demographic complacency? The honest answer is all of these, but each lesson depends on the timing and the institutions involved. One of the most debated questions concerns the speed of cleanup. Japan's banks were criticized for recognizing losses too slowly, allowing weak borrowers to survive and blocking new firms from receiving capital. But rapid liquidation would also have destroyed jobs and pushed the economy into an even deeper recession. Modern historians and economists still debate whether gradualism softened the crash or prolonged it. The same tension appears whenever governments rescue a financial system. Save the banks, and you may preserve the economy while protecting bad decisions. Let them fail, and you may punish workers and depositors for mistakes they did not make. Japan's history offers no clean moral ending. It offers a record of trade-offs made under pressure, often with incomplete information. By the 2000s, Japan had become a laboratory for economic policies that later spread elsewhere. Zero rates, large-scale asset purchases, fiscal stimulus, and attempts to guide inflation expectations all appeared in some form. When the global financial crisis arrived in 2008, Japan's earlier experience suddenly seemed less like an odd national story and more like a preview. After 2008, the United States and Europe also confronted collapsing credit, weak demand, low interest rates, and arguments over stimulus versus austerity. After 2020, governments around the world faced another combination. Disrupted supply chains, high public debt, aging populations, and households struggling with housing costs. The details differed, but the vocabulary sounded increasingly Japanese. There is another parallel, less visible in economic charts. Long stagnation changes ambition. In a boom, risk can look intelligent because success is everywhere. In a stagnant economy, caution can look intelligent because failure is expensive. People may choose smaller homes, delayed purchases, fewer children, or stable routine. These are not always signs of despair. They can be rational responses to a world that no longer rewards the old bets. That is why the most useful lesson from Japan is not growth stopped. It is that expectations stopped rising. In the same way, a society can remain affluent while feeling economically stuck. Its roads can be excellent, its trains punctual, its products sophisticated, and yet its young adults may believe that the future will offer less upward movement than the past. Japan also complicates the idea that every economy must maximize speed. Its mature infrastructure, careful manufacturing, compact urban services, and long-lived products show the strengths of maintenance. The weakness is that maintenance alone cannot solve every problem. Someone still has to finance care, replace workers, create new firms, and decide which traditions deserve protection. The crash of 1990, therefore, belongs to two timelines. In the first, it was Japan's national turning point. The moment a property and stock bubble gave way to decades of low growth. In the second, it was an early glimpse of a broader condition. Rich countries trying to function with aging populations, expensive assets, cautious consumers, and central banks running out of conventional room. The final irony is that Japan did not simply fall behind. It moved ahead into a difficult future before other countries were ready to recognize it. Its experience was visible in empty storefronts, quiet neighborhoods, conservative banks, smaller households, and policies that once sounded experimental. That does not make Japan a perfect model, and it does not make every current problem a replay of 1990. The world has changed. Technology, migration, energy markets, geopolitics, and climate pressures create new variables. But the underlying question remains remarkably familiar. What happens when a society built for permanent expansion discovers that stability itself has become the goal? Japan's answer was imperfect, expensive, and still unfinished. But it preserved a functioning society, while the assumptions underneath it were rewritten. When you look at today's housing markets, aging populations, low-growth economies, and cautious consumers, do you see a completely new crisis or the same historical pattern arriving somewhere else?